Introduction to derivatives. Types and uses of derivatives. Derivatives are financial instruments whose value is based on an underlying asset, index, or rate. They are crucial for hedging, speculation, and arbitrage, enabling market participants to manage and transfer risk. Key types include options, contracts giving the right but not obligation to buy, call options, or sell, put options, an asset at a set price before expiration. Futures, standardized contracts obligating parties to buy or sell an asset at a set price on a future date, used for commodities and financial instruments. Forwards, customized agreements between two parties to buy or sell an asset at a specified price on a future date, traded over the counter. Swaps, agreements to exchange cash flows based on specified terms, including interest rate swaps, fixed versus floating payments, currency swaps, cash flows in different currencies, and commodity swaps related to commodity prices. These instruments are vital for risk management in modern financial markets. Uses of derivatives. Derivatives serve various purposes in financial markets, including hedging. They are primarily used to offset potential losses in underlying assets. For example, companies may use futures or options to lock in commodity prices, while investors hedge against interest rate or currency fluctuations. Speculation. Traders use derivatives to bet on future asset price movements, gaining leverage exposure to potentially profit from price changes. However, this comes with significant risk, as losses can also be magnified. Arbitrage. Derivatives enable traders to exploit price discrepancies between related markets. For instance, arbitrageurs can use futures contracts to capitalize on differences between spot and futures prices for risk-free profit. Price discovery. Derivatives aid in determining the fair value of underlying assets by reflecting market expectations and facilitating trading, thereby contributing to efficient pricing and liquidity in financial markets. Structured products. Creation and valuation of structured financial products. Structured products are customized financial instruments that blend traditional securities with derivatives to meet specific investment goals and risk-return profiles. They offer unique advantages over standard financial products. The creation and valuation of these products involve advanced techniques due to their complexity and the diverse needs they fulfill. This section explores their creation, key components, and valuation methods. Creation of structured products. Structured products are designed by financial institutions to meet specific investor needs, such as capital protection, enhanced yield, or targeted asset exposure. The creation process typically involves several key steps. Defining investment objectives. Identify the goals and risk appetite of the target investors, which guides the design of the product, including asset selection and payoff structure. Designing the product structure. Financial engineers combine traditional instruments with derivatives, selecting underlying assets, like equities or commodities, and determining the payoff structure. Structuring the payoff. The payoff structure defines how returns are calculated and distributed. Common types include principal-protected products, guarantee the return of principal at maturity with additional returns linked to asset performance. Yield enhancement products aim for higher yields by taking on additional risk, such as reverse convertibles and credit-linked notes. Participation products provide exposure to asset performance, potentially amplifying returns, like structured notes with participation features. Issuance and distribution. After design, the product is issued to the market, typically through investment banks or brokerage firms, involving regulatory approvals, pricing, and marketing. Valuation of structured products. Valuing structured products requires a comprehensive understanding of their components and payoff structures. The valuation process involves several key techniques. Modeling the payoff. The initial step is to model the payoff structure based on the underlying assets and derivatives. This includes calculating expected returns and outcomes under various market scenarios using mathematical models and simulations. Pricing the derivatives. Valuation often includes pricing embedded derivatives using methods such as Black-Scholes model for pricing options and equity-linked derivatives, providing a closed-form solution based on volatility, interest rates, and time to maturity. Binomial model, useful for American options or products with discrete features, employing a binomial tree to simulate possible price paths. Monte Carlo simulations, a numerical approach that simulates numerous price paths for underlying assets, particularly beneficial for complex products with path-dependent features. Assessing risk and sensitivity. Valuation involves analyzing the product's sensitivity to market changes using key risk metrics. Delta, sensitivity of the product's price to changes in the underlying asset's price. Gamma, sensitivity of delta to changes in the underlying price. Vega, sensitivity of the product's price to changes in volatility. Market considerations. Valuation is also influenced by market conditions and liquidity, with factors such as interest rates, credit spreads, and market volatility affecting the value of both underlying assets and embedded derivatives. Synthetic instruments, constructing synthetic positions and their applications. Synthetic instruments are financial products that combine various existing instruments to replicate the payoff characteristics of another asset or position. They serve multiple purposes, including risk management, speculation, and enhancing investment strategies, enabling investors to achieve desired exposures in a flexible and cost-effective manner. Constructing synthetic positions. Synthetic positions are often created using derivatives like options, futures, and swaps. Here are some common methods. Synthetic long and short positions. Synthetic long position. This replicates a long position in an asset without actual ownership. It is typically achieved by combining a long call option with a short put option at the same strike price and expiration. For example, buying a call and selling a put on a stock creates a synthetic long position. Synthetic short position. This mimics a short sale without borrowing the asset. It combines a long put option with a short call option at the same strike price and expiration, allowing the investor to benefit from a decline in the asset's price. Synthetic futures. Synthetic futures positions replicate the payoff of a futures contract using options. For instance, a synthetic long futures position can be created by buying a call option and selling a put option on the underlying asset with the same strike price and expiration, effectively gaining exposure to price movements without entering a standard futures contract. Synthetic credit positions. Synthetic credit positions provide exposure to credit risk or hedge existing exposures. They can be constructed using credit default swaps, CDS, or credit-linked notes, CLNs. For example, a synthetic long credit position can be created by buying CDS protection on a credit instrument, mimicking the payoff of holding the underlying asset while assuming credit risk. Applications of synthetic instruments. Synthetic instruments enhance investment strategies and risk management in various ways. Hedging and risk management. These instruments are often used for hedging, enabling investors to manage portfolio risks. For instance, synthetic short positions can protect against declines in asset value, while synthetic long positions allow exposure to assets without direct purchases, providing flexibility in risk management. Cost efficiency and arbitrage. Synthetic instruments can be more cost-effective than direct investments. For example, creating a synthetic long position with options may be cheaper than buying the underlying asset, particularly in high transaction cost markets. They can also facilitate arbitrage by exploiting pricing inefficiencies between the synthetic instrument and its underlying asset or related derivatives. Enhanced flexibility. Investors can customize exposures to align with specific goals by combining derivatives in various ways. This allows for tailored positions that achieve desired risk-return profiles, including synthetic exposure to particular sectors, asset classes, or market conditions. Speculation and leverage. Synthetic instruments provide opportunities for speculative trading and leverage. Investors can bet on asset price movements, interest rates, or credit spreads, often with greater leverage than direct investments, thus amplifying potential returns.